Good afternoon, everyone, and welcome to this Easy Equities webinar with Intellidex. Thanks so much for taking the time out of your day to join us. I'm Shaun Keeling, and I'll be your host. Today, we're chatting to Phibion Makwerere again, who I will introduce shortly. A lot of you may know the name Intellidex from the awards we won over the past few years, as well as their research notes on our platform. I mean, for a number of years, Intellidex has been giving us high-quality research notes focused on specific ETFs, as well as the monthly notes that give you a summary of market events in South Africa as well as worldwide. So it's really just giving you a better understanding into the world of ETFs. ETFs are really close to my heart, as well as Easy Equities, with the platform having over 50% of assets under management invested in ETFs. It's always cool when new ones get listed on the JSE. Last week we had 2 new ones getting listed, bringing the total number of ETFs up to 78. And the cool thing about these 2 ones that got listed last week is they're both from Satrix, and they're both ESG ETFs. That means they're both environmental, social, and governance ETFs, the first of their kind on the JSE. They're the Satrix MSCI Emerging Markets ESG Enhanced ETF, as well as the Satrix MSCI World ESG Enhanced ETF. So please make sure to check out the Intellidex notes on our EasyETFs.com, the new Easy ETF platform. And I suppose that's enough about me punting it. Now over to introducing my guest. Phibion is responsible for various research projects and analysis of listed instruments. He has 7 years experience in financial analysis and administration. He has various degrees as well as an MBA, so he's much cleverer than I am. That's why I'm going to pass you over to him now. Just before I do that, just please make sure, if you have any questions, please pop them in the question and answer box at the bottom of the screen. Phibion and I will get to them later on after his presentation, as well as we have some of the Easy Equities brand rock stars in the room next to me that is answering them as we go. Without any further ado, over to you, Phibion.
Good afternoon. I'm going to talk to you about ETFs and how you can use them to build efficient and resilient portfolios. My presentation is broken down into 4 parts. I'll briefly discuss the investment planning and investor archetypes, sort of to set the scene for our ETF strategy. I'll also do a brief discussion on why ETFs are a bit cooler than mutual funds. This basically makes the case for adopting ETFs as an integral part of an investor's toolkit. Then finally, we will try to put sort of everything together by constructing an ETF-only portfolio. Investors' unique profile generally determines the risk and return objectives subject to certain constraints such as liquidity, time horizon, tax regulation, etc., etc. And so guided by these objectives, an IPS is created, and then funds are allocated among different asset classes. So that you can achieve these objectives. And the common classes that we have are equities, bonds, commodities, and cash. And thankfully, all these assets are actually on JSE, which makes our life easier when wanting to use ETFs to create a portfolio. An important part of investing is deciding on what percentage of your portfolio to allocate to different asset classes. And we've got basically 2 investor archetypes, which, depending on which archetype you are, your allocation is slightly different from the other one. So for the young investor or the risk-tolerant investor, generally you have a longer investment horizon. You've got lower liquidity needs. So what this entails is that you can take a bit more volatility, but also you can take high growth investments such as equities. So your allocation should generally have more exposure to equities. And on the other side, you have got your older or the risk averse investor. Generally, it's got a very short, a short investment horizon, likely to have higher income and liquidity needs. And their primary objective is to preserve capital. And perhaps more weight should be allocated to bonds and cash. It's good to consult a financial advisor on, the sort of, to establish your exact requirements. But as a general rule of thumb, you can use a criterion, the 100 minus 1 age, the 100 minus age criterion. So say if you're 30 years old, what it actually means is you want to allocate around 70% of your portfolio to equities. As I've mentioned earlier, you have got, you can take a bit more volatility and a bit more risk. So that's the general thinking, but as I said, you should consult a financial advisor on to establish your specific risk profile. The main attraction of ETFs over unity trusts are mainly fees and performance. And due to competition among fund providers, fees are on a general downward trend. And this sort of race to the bottom on fees bodes well for investors, particularly ETF investors. But whether this is sustainable, again, it's a question for a different discussion. And on better performance, what we have observed is that ETFs have performed better than mutual funds, or rather active funds, on a risk-adjusted basis, and which make them a bit more attractive. And to sort of help explain this anomaly is that this research shows that a lot of return is actually attributed to asset allocation rather than stock picking. I don't know if you observe the market that much, but you might have observed that globally the hedge fund industry is sort of shrinking. And I seem to remember reading that a couple of them actually closed during the COVID-19 storm. So again, this makes a very good case for using ETFs instead of actively managed funds. But ETFs also come with their issues. There is a group of market observers who actually believe that if ETFs continue to grow at this rate, it might end up affecting price discovery in the market, but only time will tell. Still on the performance, this graph gives a general outline of how fund managers have found it difficult to beat the market. So South African fund managers are slightly better than the global average, but as you can see, as you go further, or as the investment horizon expands, you see that it becomes more and more difficult to beat the market. And for offshore investing, I think the ETF case is even more compelling. Also, given that ETFs are a good way to gain exposure in a market where you have limited knowledge. So ETFs are expected to grow rapidly in the next 5 years. And most of the growth is expected to come from the rest of the world, which really includes us here, the emerging markets. You're looking at, if you look at those green dots on the graph, it shows your compounded annual growth rate. So you're looking at about north of 57% for the rest of the world, which in this case includes South Africa, and a bit more for Europe, which is about 20%, and then America is expected to sort of lag, growing at an average of about 7%. This is because a lot of growth that has actually happened in the US. And just to give a bit more context, in South Africa, less than 1% of the all-share index is represented by our local equity ETFs. So, which means there's still room for the ETF market to grow. And it's also important to note that most of the AUM is in vanilla or market cap funds. But we've witnessed growth in smart beta funds, which is likely to crowd in more investors in future. So ETFs is definitely a space to watch. When it comes to choosing ETFs to invest in, I think the most important question to ask and answer is whether its methodology accomplishes your risk-return objectives. And then there are other important considerations such as regulation, your tax-free. Here in South Africa, we've got that tax-free accounts that are available to retail investors. So you also want to pick, funds that qualify in that tax-free wrapper. Costs are important, also liquidity, size, performance, and again, time horizon. So you again refer back to your IPS when choosing the specific ETFs that you want to invest in. Yeah, I think investing should be thought of in terms of both strategic and tactical sense. So here I actually show a template of how to combine different asset classes in a portfolio. The good news is that all these asset classes can be found on JSE. So you've got your core equity exposure, your core bonds exposure, and you've got your core offshore exposure and your core commodities exposure. And these 4 core exposures, you can extend satellite funds to them to enhance returns given market conditions. So your core allocation generally meets your longer term or your primary investment objectives, such as retirement, children's education, and your tactical allocation generally meets your shorter to medium term aspirations, such as speculation. Again, if you notice a trend in the market that you think will outperform in the short to medium term, it's an opportunity to invest in that using your tactical allocation. Also, you can use ETFs to manage risk. What has also happened is that we've seen several institutional managers also now using ETFs as their core holding. So they allocate, say, 70–80% of their fund to an ETF and then try to flex the other 20% and try to generate alpha or to beat the market. So you won't be doing anything that's foreign or completely new. As you can see that institutional investors are also pretty much applying the same approach here in investing. So here, I delve a bit deeper in the core portfolio. So these are examples of funds that can go into your core portfolio. And offshore exposure is important, and particularly for us here in South Africa, the outlook economically is a bit uncertain, and it is important that you gain exposure offshore. And also the rand is recovered quite a bit in the last week or so. And I think I read somewhere where they said it has, yesterday was perhaps its best level since COVID-19 hit. So it is actually a perfect opportunity to gain exposure offshore. And the satellite portion can be used to take advantage of prevailing market themes, which can be accomplished by taking position in other more focused ETFs, such as tech-focused ETFs or resources. You can also want to invest in other smart beta themes or factor themes, such as momentum, low volatility. And there's a new trend of active ETFs that's coming onto the market, but we haven't had that here in South Africa. But it's also be using your satellite portfolio allocation. You can you can allocate to these sort of active type ETFs. I think the downside of active ETFs would be lack of transparency. And for investors who need low risk or near cash exposure, there is a money market fund on JSE, the Absa New Funds Tracer. So this generally applies to people who have got high liquidity needs, as I've mentioned earlier on. And there is also the third pillar is the completion strategy. So this strategy helps to fill gaps in your existing portfolio. I've listed the latest listings because they are quite relevant to completing your portfolio. I know China has got its issues, somewhat of a culprit on how it handled the COVID outbreak, but is likely to get out of the COVID slump faster and with least scars than most countries. So gaining exposure to that fund makes a lot of sense. And also on ESG, it actually looks like it is here to stay. Come to think of it, it actually makes a lot of sense to invest in sustainable companies. And what we've also noticed is that while there are issues in the US, EU is actually going big on ESG. So it's an area that makes sense to invest in. So what also happens is I outlined broad asset classes at the beginning, but within those broad asset classes, there are subcategories or subclasses that are worth looking at. This can be explored if you want to fine tune your allocations. As you can see, there are examples that I've put there on the screen. And again, it's important to note that risk profile remains important when you want to make such tweaks in your portfolio within sub asset classes, because they are also unique risk characteristics. So it's important that you still keep to the details of your IP statement. And I've sort of created a portfolio and of how the whole thing might end up looking like. I've used some of our favorite funds at Intellidex to show what an ETF portfolio might look like. However, you want to keep the number of funds manageable to reduce complexity and trading costs, because each time you buy and sell funds, you incur trading costs. Studies generally show that you need not more than 10 ETFs of a well-diversified the ETF is well diversified. You don't need more than 10 ETFs in your portfolio. Also note that we have not attached any percentage composition of different asset classes. It will again depend on your own individual risk profile. And yeah, that's basically it for me. And I've come to the end of our presentation. And I welcome your thanks.
Phibion, thanks for that. That was really thoughtful. And just a question there before we go to the question and answers. And guys, please pop your questions in the question and answers block at the bottom of the screen, and Phibion will get to them. Phibion, how did you pick those funds that you did there? What was your guys' theory on the funds that you picked there for your core strategy? What research and did you look at to pick those?
So on the core strategy, the basic idea is to pick funds that are broad-based. As I said, your core outlook is your core portfolio is generally the fund that you want to hold for the longer period, and it has to be a very stable fund, a broad-based fund. So if you look at the funds that are in that I selected, the examples that I picked there, they are quite broad-based, and they give you a broad-based exposure sector-wise. And if you look at the offshore ones, they give you a broad-based exposure to different countries and also to different sectors.
Okay, great, thanks. See, we have a question coming there, a few coming in there. Phibion, if you can take those, and I'll also go through them.
Okay, let me open my. So there is this question here. Is there any ETF books that one can read to get a bit more understanding of ETF investing? Yeah, so there's a lot of material that has been written, and I would recommend you go to say, if you just want to have a global picture of what's happening in the ETF world. There's a company called EFGLI. Okay, I'll send the link to that to Shaun. I don't know. Can I?
We can put it in the recording later on, Phibion, so you can.
All right. Cool. Yeah, that I would recommend. There's a lot of material, and also there is material from, I know CFA has got a lot of material that I actually also used in compiling this. I'll share those materials with you. Yeah.
You can also look on our research portal. We have quite a bit of information around ETF investing, as well as our new ETF platform, EasyETFs.com, that will help you understand a little bit more about the world of ETFs.
Okay, so there's this question. Kindly explain in more detail the difference between exchange-traded funds and a unity trust, and also more info on structured exchange-traded funds. All right, so for ETFs, generally speaking, they are index tracking. So they don't, they follow set rules in investing in them. Unlike unit trusts, these are active funds. So a manager makes decisions based on some criteria, but it's not the criteria is not public knowledge. And generally, unit trusts are a bit more expensive. I think I've sort of highlighted that. And what you also find is that there is not much transparency when it comes to ETFs. When it comes to unit trusts. Unlike with ETFs, you are able to see what's contained in the ETF wrapper sort of on a live basis, which you are unlikely to do with unit trusts. So as a result, what you then have, because ETFs are managed by a fund, are actively managed by a fund manager, what you then realize is that it's in terms of costs, it costs more. You pay a bit more for you to gain exposure in that unit trust than what you would pay for in exchange traded funds. I hope I've answered you there. I've got another question here. Please advise for kids' education, 9 years, which ETFs are relevant to pick? I'm assuming that you say the kid is 9 years old and you want to say to invest for their varsity education. So it shows that there is still, in terms of the time frame, it could be classified as medium to long-termish until they get to varsity. So you can afford to take a bit more risk and look for equities that provide growth, such as your broad-based funds actually make sense here. Your top 40 funds will probably be a way to go when you want to go longer term. Yeah. All right, so this one asks, what is the difference between an ETF and an ETN? So an exchange traded fund is traded, which is the ETF, is traded on the local bourse or on JSE, and then an exchange traded note is not is a sort of like an over-the-counter product. That is usually, I know that a lot of international banks or even some of our local banks, they do issue ETNs, and so a big difference then is that ETNs are subject to higher credit risk than your ETFs, because ETFs are publicly traded on the local stock market. Unlike ETNs, where you've got to go to the specific issuer, as I've mentioned, various international banks issue these, and also some of our local banks, they do issue ETNs. I know ABSA does issue some. And so, as I've said, it's got more credit risk than your ETF. Yeah. I see several questions that are saying that they want to go over the presentation once more again. So I'll provide this to Shaun, and then Shaun will share with you the presentation. Yeah.
And it will be loaded on our YouTube channel, so you'll be able to view it later on the YouTube channel along with the presentation, and also so you will be able to get to it at a later stage. I see a question here, I'll jump in. I see that asking what the 2 new ETFs from Satrix are different from the ones they already have on Easy Equities. So they are essentially just focusing on the environmental, social, and government side of the ETFs. They focus on companies that focus on those things. That's the only way that they differ. But there are still two Satrix MSCI emerging markets and MSCI world ETFs that don't focus on the environmental, social, and governance sides versus these two that do.
I also got a question here regarding commodity-based ETFs. Is the capital appreciation that occurs purely because of commodity increasing in value, or other factors that can influence value of the commodity-based ETF? Yeah, so I think you sort of answered yourself. It is really based on the value in the price of the underlying commodity. And a lot of these commodity ETFs that we have, gold, platinum, etc., these are the commodities are actually sold on the world market in dollars. So for us in South Africa, we get the rand price. So the additional return from investing in commodity ETFs is the rand, the movement in the rand against the dollar. So that's the additional component of return that you get from investing in commodity ETFs that are listed on the JSE. So I'm sort of going to rephrase this question, but I think it says, is an income fund relevant for long-term investment horizon? Earlier on, I mentioned the main investor archetypes that we have. So we have got the less, one who is less risk tolerant or who is risk averse. And a good example would be somebody who is retired. They've got high income needs. So generally they take on an income fund with a view to preserve capital, but also to earn income from it. So examples would be your bond ETFs. They are good examples. So, but to answer your question, an income ETF can also be used in a long-term sense, because if you combine it in a portfolio sense, it actually improves your risk return, the risk return characteristics of that fund. So yes, it is. You can include income funds, income ETFs in a long-term sense. Yeah. Okay, there's another sort of important questions here. For a new person investing in ETFs, how regularly should I monitor my account? The ups and downs. And then you go on to say, I guess this speaks to emotional ability on how to monitor the funds, or should I just invest to have a 6-month or a year target? So generally ETFs are long-term in nature, but what happens is that there are specific ETFs or theme ETFs that are not broad-based. For instance, you've got your momentum ETF, you've got your resource ETF. So you can monitor those regularly if you take a view on that specific sector or specific market. When you invest in such a fund, you ideally want to not to make it a very long investment in terms of horizon, because they are quite cyclical in nature. So for those kind of ETFs, yeah, you probably want to monitor the performance regularly, and once it reaches your objectives, and then you might want to sell it. But generally, your core allocation which includes all the broad-based type ETFs, your top 40s. You want to hold it for longer, and it doesn't actually help you to be checking on it regularly, because at the end of the day, the objective is to hold it for a longer period. So yeah, so you might want to have that sort of demarcation, the core and satellite demarcation. Yeah.
So while Phibion's reading there, I see the last question that comes in is asking if ETFs are mainly for curbing inflation or for income purposes. I suppose you could use it to curb inflation, but definitely is for long-term investing to gain capital and put it away for your tax-free saving accounts when you're older, or for saving for an education or anything like that.
Yeah. Just to add on to what you have said, Shaun, I think when you invest in ETFs, you have to have your objectives right. So you might actually invest for not so a long sort of a long period, but you generally with ETFs you want to invest for the longer term. But as I've mentioned, that there are themes that you can take advantage of. Like say you've got a good feeling about a sector performing well in the short to medium term, then you can take sort of a very short view on it. Yeah.
See, there's one new one at the end there, Phibion, if you want to look at that one.
Yeah. So is it necessary to have a unit trust and ETFs in one portfolio? If so, what percentage of unit trusts must I have? My horizon is long term. So again, it goes to your specific objectives. And as I've tried to highlight during my presentation, ETFs have been performing, on average, they've been performing better than unit trusts. So, and generally because they've got exposure to similar assets, but in different weightings, you probably want to go with your ETFs and for your core portfolio, for your long-term core portfolio. But you feel a manager who perform well in a certain time frame, say 2-3 years, you might then want to allocate a small portion to that fund manager. You've been performing better, and you probably are better off just putting all in ETFs.
We don't have any more questions at the moment, so if you have any more, please fire them in, and Phibion and I will get to them. Phibion, while there are no questions there, I thought maybe you can just explain to us maybe how Intellidex does their research and how you look into specific ETFs, just to give the users a little bit more information around when they do read the notes, how you've come to the conclusions you've come to.
Okay, so there are about 78 now, right, Shaun, as you mentioned, 78 ETFs listed. So we look into each separately. So you've got your broad themes, how the market is performing, the economy or the global economy is performing. And then motivated by those broad themes, by those big themes, you can then go to specific ETFs and drill down further. So what you want to do is to look at who is the provider and the strategy behind the ETF, the costs attached to that ETF, and yeah, and basically the methodology, and see how it sort of matches or fits with the themes that we have identified on a global or on a macro scale.
Thanks, Phibion. And then while there's no more, I want to ask you, like, I know there's a few, so for instance, top 40 providers and ETFs that are available in the JSE. So, I mean, when you're analyzing them, what exactly do you look at? How exactly do you pick the one that is right for you if there are 4 that are exactly the same?
Well, yeah, so that's an important question, Shaun, thanks. So for us, it's important to separate these funds based on their costs. So if it's similar in all respects except for costs, then it makes sense that you go for the one that has got the lowest expense ratio. And also size is important, sorry, yeah. Size is important. You want to go into funds that have managed to accumulate a bit more in terms of assets. They are generally, over time, they tend to be less costly, and they tend to have longevity compared to funds that struggle to raise assets. Yeah.
Awesome, thanks Phibion. Don't have any more questions at the current time. So I think what we'll actually do then is we'll actually, I see there's one on the chat channel. Phibion, you can do this one maybe on the ETFs. Is there more risk or is it more profitable?
Sorry, Shaun, could you come again?
I think that's sorry, the Standard and Lesedi are answering that one. So I think if there's no more questions on this, what we're going to do is we're going to wrap it up now. But so thanks so much for taking your time out and giving us the presentation, Phibion, and showing us your insights. And thank you to everyone out there for joining us today. And I hope you found it informative and learned a bit about it. And we will be doing one with the Intellidex every month. So we might see Phibion on here again, or maybe we'll have someone else from Intellidex showing us the way, I suppose, in learning the world of ETFs.
Thanks, Shaun, for having me. And they can send questions to my email if needs be.
Yeah, if there's any more, please send them through, and then I'll send them to Phibion and we'll get them answered. Thanks, everyone. Have a lovely afternoon, and cheers.
Okay, cheers.